All right, that's good. So here we are. This is a webinar for a financial plan for your life. And I'm really excited to be here with Emily Claire, who is an awesome financial advisor from Edward Jones. Thanks for being here today, Emily.
Thank you for having me, Carrie. It's great to be here.
Absolutely. Absolutely. So today we're going to talk about how to take control of your personal finances and build wealth using small action steps that will have a major impact over time. And I'm going to start us off by talking a little bit about my own personal journey in money management, from being completely oblivious and knowing nothing and getting myself into debt by not thinking about money, to how I turned that around and started to master my money. And now am investing and successfully becoming wealthier every day. So there's no better time to get started than the present. So let's get started. So one thing I just wanted to touch on before we get into it is why we don't like to talk about money. It's fascinating to me that this topic is still considered pretty taboo in our society. It's still considered for a lot of people impolite or rude to bring up money or ask questions about money with their friends, family, and colleagues. And I think that we have as a society a pervasive belief that somehow money is bad or evil. And I remember clearly when I was just a kid of about 8 years old, I kept a journal. I've always kept a journal. And I remember writing in it that when I grew up, I did not want to have a lot of money. And I remember the feeling I had when I was writing that was that I didn't think you could be both a good person and be rich. I'm not sure how I picked up that belief, but somehow I had absorbed that belief as a young child. And I think a lot of us, whether we're conscious of it or not, do have that belief. There's a saying that money is the root of all evil, which actually it should be from the Bible. It is the love of money is the root of all evil. But money itself is neutral. It's not bad or good. It's what you do with it. It's merely a tool, right? So that's why we're here, to talk about money. Because after all, although money is not everything, it ranks right up there with oxygen, which is this quote from Zig Ziglar. I mean, like it or not, we need to have it in our society to live, to do anything. And so we might as well learn how to use it, how money works, and how to win at the game of money. Whether you want to have money to get things or gain experiences or have freedom over your time, these are all things that people desire and have the right to have. And after all, if you're a good person, you'll likely do good things with your money. And if you're a bad person, you might do bad things with your money. It's not going to change who you are. It's merely going to amplify who the person already is. So you might be wondering, why do we need a plan? I mean, why can't we just go out and make a lot of money? Why do we really need to have a plan? And I can speak from experience on this because I was at one time making a great income, but found myself $100,000 in debt. And that's when I woke up and I said, okay, enough is enough. I can't just keep going by, footloose and fancy free and not thinking about my money. I have to really master my money, or it's just going to continue down this path. So for one thing, we live in a very consumerist culture, and it's getting more so as time goes by. We are bombarded with marketing messages from the time we wake up to the time we go to sleep, and more they're getting sophisticated, and it's becoming easier for us to spend our money. We can go on Instagram or Facebook, and with just a click, we see something we like, and it's on its way to our house, and we've spent that money without even really thinking about it. Impulse buying is definitely becoming easier. And so it's interesting too, if you think about it, I've read some books on this. Our society would like us to believe that spending money is a patriotic act, that we're building the economy, that we're contributing to the GDP, and that somehow it's patriotic of us to spend our money. And that may be well and good for the economy and for, all those companies' bottom lines, but we also have to look out for our bottom line, our personal bottom line. And more Americans are going into debt every day. So we really have to be purposeful about our money and make sure we're defending our money. So we're going to talk today about setting a financial goal or goals. So what about your goals? Are you thinking of buying a house or an investment property? Are you trying to pay off debt like so many people are? Are you looking to send a kid to college or put yourself through school? So we'll talk about how to focus on your goals and set SMART goals. And then we'll also talk about how to make those goals happen. It's important to really get started right away. So I'll give you some action steps to take right after this webinar. And even if you just do one of those things within 24 hours, it will start to build some momentum. Here's a simple graph that shows the power of compound interest over time. And as you can see, the sooner you start, the better, because the power of compound interest is in the time where it starts building on itself. And so it's never too late and never too early to start investing. Einstein was quoted as saying, the compound interest is the eighth wonder of the world. He who understands it earns it. He who doesn't pays it. So again, let's know the rules of money and make sure we're winning at this game. So again, why do we need a good plan? Well, I once upon a time thought that freedom was not caring or thinking about money. And then I learned the hard way that in order to have that freedom I wanted, it was important to have discipline and structure around my money. So having some discipline and some forethought and planning is actually going to lead to freedom and empower you to focus on and achieve your goals and have clarity over choices. When you know when you can spend money and what you can spend money on. And I don't know if any of you are familiar with FIRE, which is an acronym for Financial Independence, Retire Early. If not, I would invite you to just Google that when you're done with the webinar. It's really interesting and inspirational, I think. Basically, financial independence is just when your passive income, the income you're not working for, is equal to or greater than your expenses. So you don't have to work for money at that point. You are financially independent. And the FIRE movement is, in a nutshell, it's something that was started by a blogger who calls himself Mr. Money Mustache. And he decided at a very early age in his 20s that he was going to retire early, basically by 30 or 31, because he wanted to raise his son with his wife without having to work. He didn't have a child yet, but he decided in advance that that was what he was going to do. And so they were both working. They put a plan in place where they set aside at least 60% of their income instead of living at or beyond their means like so many Americans do. They cut their expenses and aggressively saved and invested over 60% of their income for 10 years. And what that meant was that by the time they were 30, they were financially independent. They could live off the dividends of their investments. And by the way, they weren't risky investments. We're talking like mutual funds, very safe, low risk investments. And they were able to do this. And then he shared his system on his blog, and it started the FIRE movement. And now all these younger people are on a path of retiring early by saving aggressively and investing aggressively and cutting their expenses at the same time. So, and one last point is, by the way, they're still working, but they just do it when they want, out of passion for the work, not because they have to. So I invite you to consider what you might do if you didn't have to work. All right, so let's take a moment to take your financial pulse. you have to know where you are before you can know where you're going. And one way to do that is to calculate your net worth. So your net worth, your wealth is not your income. Your wealth is what you own. And that's true even if you're Bill Gates. He's not wealthy because of his income. He's wealthy because of his assets and his net worth. It's very simple to calculate your net worth. It's just the cumulative value of your assets and subtract the total value of your debts. And basically what that is it's the bigger picture of your financial situation. And it's like your scorecard of where you are financially. So some of your common assets are right here on the screen. You've, of course, got cash and checking and savings account balances, securities, collectibles, the value of any businesses you might own, real estate and other property, and any equity you have in vehicles. And then the most common examples of debt would be student loans, alimony, mortgages, amount that you owe on those, amount that you owe on your vehicles, credit card balances or lines of credit, back taxes, medical bills, judgments, and personal loans. So basically you have your assets in one column, your debts in another, and you subtract the debts from the assets, you have your net worth. So if you were to stop working today and liquidated all your assets and then paid off your debts, your net worth would be how much you have left over. And it is possible to have, again, a high income and a negative net worth if you're overspending beyond your means. On the flip side, you can also have a relatively low income and have a really high net worth if you're managing your money effectively. And then the more assets you have, the more you can leverage them to make more money by investing. An example of that might be taking out a line of credit on your house to invest in an income property. So the idea is to track and then to grow your net worth over time and have your money start working for you rather than the other way around. And you can make this a game with yourself and your spouse or significant other if you want. And look at it like every quarter and see if you can grow it over time. Anytime you can gamify this, it makes it more fun. And then the other important piece of knowing where you are financially is your budget. So if you're anything like me, you might be resisting doing a budget and think it's super boring. But again, having this discipline now is going to save you time and money and help you build your wealth quicker. So basically your budget measures and forecasts your regular expenditures against your cash flow. So whereas your net worth is your big picture, budget is your monthly snapshot of your cash flow in and out. So it's just like a company's profit and loss. This is your household profit and loss. And the way you do it is you want to have an Excel spreadsheet and have categories for all your kinds of spending, utilities and things like that, and then groceries. And if you have pets, you'll have something for pet care, and children will have things that they'll need for them. I have a template I can share, or you can easily Google online and find something, but this should be a living, breathing document. And over time, the great thing is you can go in and see where your biggest expenses are and try to figure out ways to reduce them, which again can be kind of exciting. You make it a game, like how little can I spend this month? Or how can I really hack at those big expenses that I have? For example, housing is usually our most highest expense as Americans. It's usually about a third on average of our budget. So what might be a way that you could reduce that huge cost that you have every month? I do have a webinar in June about house hacking. So if that's something that interests you, feel free to put that on your calendar. And then if you really want to know what's going on, try tracking your spending in real time. And I did this last January, and I found it to be really eye-opening. I'd heard that I should do it many, many times. I finally bit the bullet. And you basically just record every dime or penny even that you spend throughout the day in a little notebook or on your computer or on your phone. But you just take note of every time you spend cash or use your debit card or, Venmo, whatever it is. And it just makes you so much more aware and conscious of your spending habits. So I found it to be very, very useful because, again, it's so easy to spend without thinking. So I would recommend trying it for at least 30 days and you'll see where your money is actually going. And then another exercise I recommend is making your happiness list. And this one's really fun. So you basically just take out a sheet of paper and you write down 10 things that make you the most happy in life. And it doesn't have to be in any particular order, just the first 10 things that come to your mind. And then what you want to do is take this and compare it to your budget and your spending habits, if you're tracking your spending. And then ask yourself, do they match? Are you spending money on the things that actually make you happy? And I took this from the FIRE movement, and one couple who basically changed their whole lifestyle around, for example, they were living in a huge house in San Diego right on the beach. And it was lovely, it was beautiful. But they did their happy lists and then they looked at each other's and they realized that the beach was not on either one of their happiness lists. And they really weren't utilizing the beach that they were spending so much money to live right next to. So they decided to sell that expensive home and move to an area that did meet more of the items on their happiness list, like hiking in the woods, for example, being closer to work so they didn't have to commute as far. And so that's just one example of why it's important to actually ask yourself those questions. Does your money and your spending habits reflect what actually makes you happy in life? Okay, so from there, let's talk about setting your money goals. So whenever you're setting any kind of goal, make sure they're SMART goals. You might have heard this before. They should be specific, measurable, achievable, relevant, and time-bound. And I'll just tell another quick story to illustrate why this is important. So I first discovered the power of written goals when I set out with the intention to buy a home, and it was actually going to be a 2-family home with my family. At the time, my husband and I had a 3-year-old and an infant, and we were living in a 2-bedroom apartment. And I also knew that owning a 2-family would be a great financial foundation for our family going into the future. So it was a very relevant goal. And we made it time bound. We wanted to do it within 1 year. And it was measurable and achievable because we broke it down, how much did we need for the down payment? And then how much did we need to save to get to that amount? And how many sales did we need to make to get to that amount? So I had a specific plan, an action plan laid out for the year. Now, I'll be honest, I really didn't look at it that much. I did have it written down. And yet when I got to December and tallied up how much I had made, I will never forget, I was just completely blown away because I was within $1,000 of that goal that I'd written down at the beginning of the year. So to me, that just, I'll never, again, underestimate the power of writing down your goals. There's something magical about it. Also, when you're thinking about your goals, think big and look at your 10 or even 20-year goal as a starting point, and then break it down to 5 and 1 year goals. A lot of times people will overestimate what they can do in 1 year, but they'll underestimate what they can do in 5 years. And so think about your someday goals. Think about where you want to be in 10 or 20 years, and whether that's financial independence or whatever it is for you that's meaningful and relevant. Then you can break it down to, well, what do I have to do in the next 5 years to get there in 10? And then if I want to get there in 5 years, what do I have to do in the next year or 2 or 3 to be there in 5? And you can really put concrete kind of goalposts in place doing it that way. and then break it down into action steps that you can put into your calendar, and then you have a concrete path to follow. So now that you have clarity around your current reality and where it is you want to be, it's time to take some action so that all of your planning can take wings. So it's really important to take some kind of action right now. So I would encourage you to actually brainstorm a list of actions. Don't hold back. Just brainstorm anything that comes to your mind after you've set your goals. And you may find that you don't know how to do it yet. Still make sure you write down your goals. But as you start, moving those wheels in your brain towards your goal, opportunities and thoughts will start coming to you that you hadn't thought of before, and be open to those opportunities. I have a list here of suggested action items. So it's all depending on where you are in your financial journey, but you could start by tracking your monthly income and expenses if you're not doing that, and then compare them to your happiness list like we just talked about. Decide which expenses you could reduce or eliminate, and there's always going to be something. I'm always looking to see what expenses I can be cutting, and challenge yourself to see how much you can save. Start an automatic debt reduction or savings plan, and there are many ways to do this. There are certain apps that I found useful, like Albert, Acorns, and Capital for saving and even investing. You can set up an automatic bill pay and things like that. You can talk to Emily, who's going to be speaking in a moment, about setting up an automatic savings and investing plan, and she'll hold you accountable to it, which is another layer. But yeah, it's just important because we, as humans, we're naturally lazy. So it's important to make sure you set up automatic bill payments and your saving and investments so that you can it will just happen without you having to think about it. So I do that as much as possible. And then action item 5, I would encourage you to schedule budget dates with your significant other if you're not doing so already. Make sure that you're on the same page and you know each other's goals, and that way you can support one another in your goals too. I know my husband and I do it every month or so. We try to, we get busy, but that's our goal. And we have on the same sheet as our budget, we have like 3 goals that we're working toward together financially. And so it feels really good when you can check one of those off, like a debt that you paid down or amount that you wanted to save, whatever it might be, or reduce an expense. And so we always have an eye on those. And if you don't have a significant other, do this with your best friend or a family member. It's always good to have that accountability and help each other. So what would be your one thing? Just pick one thing that you can do in the next 24 hours. And it might even be just scheduling something in your calendar, like 30 minutes in your calendar to brainstorm your actions or to start working on a budget. But put it in your calendar, just one thing that you can do in the next 24 hours. And again, that will help you build some momentum. Maybe it's reading a book. I'll recommend some books for you too. Let's see, I think that's the next slide. Oh, no. And as I mentioned, always tell someone, make sure that you have an accountability partner, or tell everyone you know. And that way, you're putting it out there and you're going to feel much more accountable to your goals. Here are the recommended reading that I have, and these help me a lot on my own journey. Rich Dad, Poor Dad is actually, all of these are pretty quick reads, pretty easy reads. I didn't put on here anything too technical on here, but they're just great kind of manuals for building wealth. Rich Dad, Poor Dad is an amazing book. Opened my eyes about investing. I know a lot of investors started with this book. Then there's my own book, You Can Have It All with Real Estate. It talks a lot about the mindset of money, which we kind of started talking about in the beginning, and also investing strategies for amateur real estate investors. And then Your Money or Your Life by Vicki Robin is an interesting book. She helps you break down how much of your time you are paying every time you buy something. So she helps you calculate what it costs you in time of your life to buy something you're looking at purchasing, which again, just puts into perspective any kind of purchase. The Compound Effect, great book about habits, which can be applied to any kind of long-term habit, whether it's money or weight loss or anything else you want to change in your life. The 4-Hour Work Week, very famous book about managing time. And Playing with Fire, this is a book by a guy who did the FIRE strategy successfully, and also he produced a documentary about it. I Will Teach You to Be Rich is geared more towards millennials, but I found it super helpful as well, just about personal finance and kind of no nonsense advice. The One Thing by Gary Keller, great book just about focus and how to knock down the first domino in any goal that you're trying to achieve. And then I really strongly recommend that if you're interested in financial freedom and building wealth, you definitely look into the Bigger Pockets Money podcast. You can get it, iTunes or anywhere else that you can get podcasts. And it's basically stories about people that have achieved financial independence, and it's their money story and how they did it and the mistakes that they made. So it's just really a great community of people that are kind of on the same page as you. All right, so I'm going to sign off now, but I did just want to let you know too that I have some upcoming events that you might be interested in. The next one is February 2nd. It's the Millionaire Real Estate Investor. Pretty self-explanatory. It's about investing in real estate and how to build wealth through doing so. And I have a first-time seller webinar also in February on the 23rd. And then I had mentioned earlier house hacking and flipping. That's not till June 29th. But if you are interested, please put it on your calendar. You can sign up on Eventbrite for all of these. And also you can access my full library of webinars on my YouTube channel. Okay, so thanks so much for listening, and I am going to stop sharing now and hand it over to Emily.
Okay, thank you, Carrie, for having me, and thank you everyone for taking the time to listen. I just want to say that Carrie's book, You Can Have It All with Real Estate, actually helped me to make the decision to buy a home, and so I recently did that. I just moved into my new home. It's not decorated yet. I'm working from my new house that I moved into on Saturday, so thank you, Carrie, for everything that I got from that book and for helping me with that. So, so my name is Emily Claire. I am a financial advisor. I work for Edward Jones. My office is in the North End in Boston, and I work with clients in the greater Boston area and even in other states. So if anybody has any questions for me after the presentation, I'm happy to be a sounding board for any questions you have. So let me go ahead and share my screen. So today what I'm going to talk about is the foundations of investing. So understanding some general principles, and the investing I'm going to focus on is your liquid investing. So Carrie focuses on the real estate part, and my area is really the liquid investments of stocks and bonds and mutual funds. And I'll talk to you about some good principles to apply, and also some of the basics of what a stock and a bond is and how they help you earn money. So I help my clients by getting to know what is most important to them and helping them build a personalized investment strategy and then partnering with them to stay on track throughout their lives. So if you were to consider working with me, the first step is really, and very similar to what Carrie was mentioning, where am I now and where do I want to be? That's the starting point. What's your vision for the future? What do you want out of life? And then then I go back and take a look and I say, okay, are you tracking in the right direction? Do you need to adjust the plan? And sometimes a very small adjustment can have a really large impact when you're talking about something 20 or 30 years from now. So having that conversation sooner can be really valuable. And then I can help you come up with a strategy to get there. That's the second meeting, as I talk about, how you're tracking and what strategies I think you could benefit from. And then at that point, if it makes sense for us to work together, you could become a client and we can work together partnering after that. And that's where the real value comes, because it's the ongoing coaching and conversations, the accountability, the facilitation of conversations with your significant other, and adjustments to whatever happens in your life to help you adjust and stay on track. And of course, figuring out how to manage your investments through all that. So today I'm going to focus on investing a little bit more. I'm going to get to my right page. So the first thing you really want to think about before you start investing is why. Why is it you want to invest? And if you don't know that, maybe take some time to think about it. It's sort of like thinking about what makes you happy before you start spending money. Why is it you want to invest? And then that will help us understand how to invest for you. So once you understand that, you can start building a strategy. And here are the 5 principles we're going to talk about today. So that first one is develop a strategy, then sticking with quality, diversify, invest for the long term, and focus on what you can control. So as you're thinking about your strategy, there are a lot of tools out there at your disposal, and some of them involve retirement plans at work. So I just want to mention that if you have an employer retirement plan at work and they're offering you a match, then as a very first step, I'd say make sure that you're contributing enough to get the full match, because that match that they're providing is free money and you don't want to leave that on the table. So hopefully you can then grow from there with your employer retirement plan. If you don't have an employer retirement plan, maybe you're a business owner, then somebody like me can help you set something up. Or you can also contribute to IRAs or just regular investing without any special tax features. So one thing that you want to keep in mind is that most individual investors make their money over time rather than overnight. And that kind of goes back to the chart that Carrie showed us with the compounding over time. Successful investors we've known follow a set of guidelines and rules, and as often is the case in life, the rules are simple, but they're not always easy to follow. And that's why having an accountability partner and reviewing your plan is helpful. So let's go through these different rules. Rule number 1, develop a strategy. So your investment strategy should really be based on 3 things. First, determine your long-term goals. Then think about what your investing time frame is for each goal, and understand your comfort level with risk, your risk tolerance. So for example, you may be thinking about funding your child's education in 10 years or your retirement after that. It's very difficult to stay focused on your long-term goals when things happen in life, like a temporary market decline, like what happened last March. Also, there may be fad investments that are very popular that you might be tempted to buy into that aren't really aligned with your long-term goals. So that's why it's important to stay focused on the long term by having a strategy in place. So your comfort level with risk, understanding your risk tolerance, in my practice, it's just a 6-question questionnaire and a conversation that we have. But the purpose of that is to put you in a strategy that you can actually handle staying in, even if the market goes up or down. So obviously market going up, we all like that. But if the market goes down, we don't want you to abandon your strategy at that point. So that's why we look at the risk tolerance first. And what we want to do is balance your comfort level with risk and the return you're hoping to achieve. So the next rule of thumb is to stick with quality. Whether it's real estate or liquid investments, in either case, you want to stick with quality and be careful of fads or hot tips or current hot market items. Right now I hear a lot of people talk, some people are talking about buying gold or Bitcoin or other cryptocurrencies. I also, I see a lot of people interested in tech because tech has recently been doing well. But regardless of what's happening, what's hot right now, you really want to back up and look at what's quality. So that's our next rule, is stick with quality. There are over 65,000 stocks available globally. So here at Edward Jones, we filter those out based on geography, longevity, size, and quality. And then we further narrow it based on identifying companies that have a sustainable competitive advantage, experienced management teams, and strong financial positions. Then we use analysis to determine what is a fair stock value for this, fair price for this stock. And then we then choose which companies based on this whole analysis, the fundamentals of the company and the stock price, to determine which ones we rate as a buy rating. So that's how we determine stock quality here at Edward Jones. But bonds also have varying qualities. So, when interest rates are low, we may be tempted to buy bonds that pay higher interest rates or higher yields. But a lot of times the reason they pay a higher yield is because they're lower quality bonds. So they may be at higher risk of default and not having their interest payments paid. So you really do have to be careful of bond quality as well. So stocks and bonds are just two of the more common types of investments, but this quality focus can extend across all of your investments. Investment success depends on buying and holding quality investments in a well-diversified portfolio and maintaining a long-term perspective. So let's talk about the next one. The next rule is diversify. So no single investment performs well under all conditions. If a large portion of your portfolio is concentrated in one type of investment and bad news causes its value to drop unexpectedly, your long-term financial security could be in jeopardy. So diversification won't guarantee you'll make a profit or keep you from losing money. Investing does not involve guarantees, but diversification can help reduce risk. So there are several layers to diversification. One is allocating your investments. So that's whether you have it in stocks or bonds or cash. That's what this pyramid is representing here. And that is allocating your investments is the single best step you can take to improve your investment return potential. Over 90% of the variability of returns is determined by how you allocate your investments. That means that asset allocation has a much bigger impact on your investment success than efforts to time the market by buying or selling stocks when you think they are nearing highs or lows. So here we have the pyramid, and we start at the bottom. This is cash. The blue is cash, the brown is income, green is growth and income stocks, yellow is growth stocks, and purple is aggressive stocks. So coming down here to cash and cash equivalents, this could be a savings account. These are your day-to-day expenses, money for maybe future investments or your emergency cash. It doesn't pay much income at all, especially now, the interest rates are very low. Then you can get a little more income by buying CDs and bonds. They are generally lower risk with a lower growth potential compared to stocks, but they reduce the overall risk of your portfolio. So owning bonds creates a ballast or a stabilizing factor in your portfolio. Then as we move up the pyramid, then the investments get riskier and also higher chances of more volatile, but more potential for growth. And, so those are the stock investments, the equities up there. So the higher you go up the pyramid, also, they have a higher chance of beating inflation. So let's talk a little bit about inflation. So you want to have the right mix that's going to help you keep up with or beat inflation as needed for your long-term goal. Historically, the inflation rate has been around 3% a year. That means that after 25 years, the cost of living would have doubled. So think about what you paid for your car, your house, or your coffee today and double that amount. And that's what you might be paying for at 25 years from now. So you definitely need to be keeping up with that, especially for your long-term retirement goal. So let's talk a little bit more about different kinds of assets. We talked about asset allocation. That's the importance of how you spread your investments. But you can also diversify. So this is allocating between stocks and bonds. You can also diversify within those kinds of investments. But let's talk about what a bond is. Let me check the time. So a bond is a debt security. It's an IOU. You're basically the lender giving money to a government agency, a city, a town, a company, and they're going to use that money for a certain period of time. Usually it could be between 1 year, 1 day, or 30 years. And this, this is money that they will continue to keep until that maturity date, that end of that period of time that you lent it to them. But during the whole time that you own it, they'll pay you interest. Usually it's twice a year. So most bonds start at a $5,000 minimum investment, and they increase in $1,000 increments. The bond's initial price, so the $5,000, is called its par value or face value. And once the bond is issued, then it can change in the market, and it changes because of interest rate changes. So if the bond goes up in value, you can buy it at a premium, so it's more expensive. If it goes down below the 5,000, you can buy or sell it at a discount. The longer the maturity of the bond, so if it's 30 years rather than 10 years, the higher the interest rate. But when interest rates change, the longer term bonds are more impacted by changes in interest rates than shorter term bonds. So there's an inverse relationship between interest rates and bond prices. When interest rates go up, bond prices tend to decline. So if you bought a bond and then the interest rates decline, your value of the bond will increase. But if interest rates rise, the value of your bond will decline because your bond is now being compared to new bonds that can be issued. So one thing to remember though, is if you're planning to hold the bond to maturity, it doesn't matter if the interest goes up and down or the value goes up and down, because you'll still get the $5,000 back when it matures. So currently, another thing that's happening with bonds is they can be called. So sometimes the issuer decides to pay them off early. And that is happening because interest rates are low. And that is kind of creating a problem for some people because they had a nice bond that paid a nice interest rate. And now that bond was liquidated. Now they have cash, which doesn't pay much of anything. And the bonds that they can buy in exchange aren't as good as the one they had. So that's another kind of thing that can happen with bonds. They can be called prior to maturity. Okay, so that's a little bit about bonds. And let's talk about the stock market. So just a little story about why do we say we have bull and bear markets? So it's based on how these animals fight their adversaries. So when a bull is attacking, it raises its head. And so that is a bull market is going up. And when a bear is attacking, it swats its paw downwards. And that is the bear market going down. So when you hear bull and bear, it makes a little bit more sense why they say that. So when you're buying stocks, you're basically investing in a publicly traded company. You're basically owning a small piece of that company. And you can make money in two different ways: capital appreciation and dividends. A little bit more about capital appreciation. This is the difference between what you pay for the stock and what you receive when you sell it, if it has grown in value. So here, somebody bought a stock for $20 and then they sold it for $30. Their capital appreciation is $10. Remember that the stock price could also go down, and if you sell it at a loss, then that's called capital loss. So hopefully you don't have to do that. Dividends, on the other hand, are payments to shareholders made from the company's earnings. So while you own the stock, the company may pay you dividends. It feels a little bit like interest, but it's different. It's usually paid quarterly. It can be paid in the form of money or stock, and the dividends are not guaranteed. So they can increase, decrease, or be eliminated altogether. So last year with coronavirus, a lot of companies just completely eliminated their dividends as a way to manage their finances and their cash flow. There are some great companies out there that have a history of continually raising dividends year after year. So that's another way you can make money just by owning it. Dividend paying stocks tend to be stocks of well-run companies that have these extra money, this extra earnings that they can pay shareholders. And here's why that's important. Those high quality companies that pay dividends have in general had higher historic returns. You see the 9% there than the ones that don't pay dividends. See down there at 2.6%. So dividend paying stocks not only do they pay dividends, but they tend to be quality companies that can continue to grow. Another way you can diversify is to distribute your stocks by sector. So there's the technology sector, there's energy, there is consumer discretionary. There are all sorts of different sectors in the market. And instead of buying all of your stocks in one sector, you can diversify them across different sectors. A lot of people like technology. It's certainly a great sector, but if you have 100% of your assets in technology and you think about the booms and the busts over the last 30 years, like the dot-com bubble, the different things that have happened, you would have been on a wild roller coaster ride if all you owned was technology. So by having a diversified portfolio, you give a little more stability to your experience. So another way you can diversify your portfolio is through packaged investments. These include mutual funds, exchange traded funds, and unit investment trusts. So these are basically investments that own a large basket of stocks or bonds or both. And so you get built-in diversification just by owning it. And so that's a good way to diversify and to get professional money management to help you with that. So like I mentioned, diversification is the key aspect of mutual funds. And so I'm going to talk a little bit more about mutual funds as an example. So typical fund would own approximately 100 companies or more stocks. And that means that if there's a loss in some of those stock holdings, they're offset by gains in others. So it minimizes your risk or lowers your risk. Remember that diversification does not guarantee a profit or protect against loss, it just reduces risk. The other aspect that you're getting from mutual funds is professional management. So each fund is run by professional managers, and they have research analysts, traders, and financial analysts that are researching and doing this full time. So they can manage your money for you, so you don't have to be trying to make those decisions, and you can take the burden off of you. So once you own a mutual fund, there are a couple different ways you can earn money there. The mutual fund can earn interest from their bonds, or it can have dividends paid out from their stocks. And they subtract the expenses for their fund management and pass the earnings on to you as dividends. Also, the share price of the mutual fund can go up or down in value, and it can go up in value when they sell securities at a gain. And at the end of the year, or certain times, usually once a year, a lot of mutual funds will distribute capital gains to their shareholders. So of course, the value can fluctuate because the stocks and bonds inside the mutual funds can fluctuate as well. Another thing you can do is to go into an advisory program, which is basically looking at a professional manager, somebody like me, or one of our teams at Edward Jones, managing the mutual funds that you own proactively for you. So, okay, rule number 4, invest for the long term. So you need a financial strategy that will not work just for you in the short term, but 25 years or more from now. And if you think about all that's happened in the last 84 years in this country, the wars, the setbacks, all of the bad things that have happened, still in spite of these, our nation and our financial markets have persevered. So CNN or whatever news channel you watch, they're always trying to scare us. But if you look at the long term, we have persevered. Even the 1930s, we broke even. And 2009 was one of the worst years on record. It was decades on record, ending in 2009. It only went down 1% that decade. And the following years after that, it tends to have a much higher return. So that was 13% after that. So if you can hold out for the long term, you can take advantage of the growth that follows these difficult periods. And another way you can do this is to buy systematically. So if you buy systematically over time, then you end up buying more shares when the market is lower, and fewer shares when the market's more expensive. So it also helps you kind of average out the market volatility a little bit. So lastly, you know, you want to focus on what you can control. I really love this phrase. If you're ever stressed out about everything that's going on, just tell yourself, focus on what I can control. And you can control some things like your savings and your spending habits, which Carrie talked about already. And that is how you can prepare and protect yourself. So some ideas for how you can do this: establish an emergency fund. I would aim for, generally, I would say aim for 6 months, but that could be particular to your situation. So that's money to protect you if there's an unexpected illness or a job loss or anything like that. The next is to control your level of debt. Debt is a necessary part of our lives and part of our financial picture, but credit card debt, it can be problematic, whereas, you know, mortgage and your car and your education are less problematic. They can be helpful. So manage those credit cards. Control the way you respond to the stock market dropping. It will go down at some point, and at that point, you could rebalance, you could buy more, or you could hold steady. But if you sell at that point, you're going to miss the recovery. You can't control tax laws, so you can diversify your tax strategy. There's the tax now, tax never, and tax later money, and you can diversify how you manage your tax strategy. You can learn about your own risk tolerance and make sure you invest in something that you can feel comfortable with, that you're not going to leave at, you know, when there's a short-term setback. And you can control the quality of your investments with diversification and how long you hold them. So one thing I would say is just don't make emotional decisions where your money is concerned. So that's it. Those are the 5 strategies. Develop a strategy, stick with quality, diversify, invest for the long term, and focus on what you can control. And, you know, if anybody has any questions, I'm happy to answer them. I didn't put my contact number information on there, but Carrie knows how to reach me, or you can find me on LinkedIn, Emily Claire. Thank you so much.
Thanks, Emily. Yeah, and I will make sure to email everyone Emily's contact information along with a recording. But yeah, thank you so much. It's a lot of information, but it's great to start to get more of a handle, you know, on this stuff. And I highly recommend working with Emily. I've been working with her for some time now, and she's super calm and helps you keep your, you know, your eye on the goal and the long-term goals, where sometimes it's easy to get distracted and fall off track. So she's great, and she really cares about her clients.
Thank you.
So
I would also say Carrie is the one who helps me with my home purchase, and so not only her book, but then I actually worked with her on that, and I really appreciate that, our partnership. So
for sure, me too. Well, if anyone has any questions, we're here now, and we're happy to try to answer any questions you have. And of course, you can also email or call us. I think, Emily, you do offer free consultations, right?
yes, I do.
Okay.
I'm happy to have a phone call about anything, or email. Usually I have to do a phone call to really answer questions, but I'm happy to have a conversation with anybody who wants to.
That's awesome. And likewise, I also do free consultations if people have real estate questions, or happy to chat about any of the topics we covered today. Awesome. Great.
Thank you so much, guys.
Yeah, thank you for joining us, Kristen.
Sure. If I have any questions, I'll definitely reach out.
Awesome. Please do.
Thank you.
Same here. Thank you.
Thanks, Yvonne. Thanks, guys. Well, have a great rest of your day and a great weekend, and hope to connect again soon.
All right. Thank you.
Bye. Bye, Emily.
Bye.